All right, welcome to the Explainer. Today, we're diving into two platforms that have, completely different ways of looking at the world of investing. Tastytrade versus Robinhood. And really, this gets to the heart of the matter for so many of us, right? Do you want something that's super simple and easy to use, or do you need something with some serious power under the hood? The path you pick here, it can seriously change your whole game. So in one corner, you've got Robinhood. You know the app that basically made commission-free trading a household name and made investing feel like anyone could do it. And in the other corner, you've got Tastytrade. This is the specialist tool, built from the ground up for someone who's really active, especially with options. All right, let's kick things off with a platform that really shook things up. We're talking about Robinhood, the one that pulled in millions of users by making things simple and, of course, commission-free. I love this quote from a Reddit user because it just nails the Robinhood experience. It's like going to Vegas for all the cool freebies, the cheap rooms, the great food, but you gotta have the willpower to stay away from the sots. The idea here is, yeah, take advantage of the awesome deals they offer, like that IRA match, but you have to be disciplined enough to sidestep all the flashy stuff designed to make you trade all the time. So, what's Robinhood all about, really? Well, it boils down to a few key things. You've got this super slick mobile-first app and zero commission trades. I mean, that's a huge win for beginners. But, and this is a big but, people often point out that it feels a little gamified, and the tools for doing deep research, they're kind of limited. And you've got to ask, how can it be commission-free? Well, nothing's ever truly free, right? A big chunk of Robinhood's money comes from something called payment for order flow, or POFF for short. Basically, they send your trades to big market makers who pay Robinhood for that business. Now, this is a pretty standard industry practice, but it's definitely been a hot topic and a source of concern for some users. Okay, so let's completely switch gears now. If Robinhood is like a fun smartphone game, then Tastytrade, well, Tastytrade is more like the cockpit of a 747. It looks complicated, but it's packed with power and built for a pro. So Tastytrade comes from some serious pedigree. It was built by the same folks who created the legendary thinkorswim platform. And their goal is laser-focused. They want to give active traders, people who are really into options and futures, a super powerful, efficient, and cheap platform to execute their strategies. And this right here, this visual really tells the whole story. Look at the options chain on Tastytrade. It's just loaded with information. It neatly separates weekly options from monthly ones, and boom, the bid-ask spread, that's the price difference between what someone's willing to pay and what someone's willing to sell for, it's right there in your face. Now on Robinhood, that same critical info, it's not as obvious. You gotta do a bit more digging to find it. So yeah, the interface might feel a little intimidating at first, but there's a really good reason for it. Tastytrade gives you some serious firepower. Powerful analytics, the ability to backtest your ideas, and a massive library of educational stuff that's all designed to make you a smarter, more strategic trader. Okay, talk is cheap, right? Let's get practical. We're going to run a head-to-head comparison with the exact same trade on both platforms and see what it actually means for your money. So here's the plan. We're using a pretty standard option strategy. It's called a short call credit spread on Apple. We're going to place this exact same trade on both Robinhood and Tastytrade and see who comes out on top. First up to bat, Robinhood. And just like you'd expect, the commission to put on this trade is a big, fat zero. Can't be free, right? Okay, now over to Tastytrade. To open the exact same position, it's going to cost you $1. But here's the key detail. Closing the trade is free. That's a big part of their whole pricing model. So you might be thinking, okay, easy. Robinhood is cheaper. But hold on, that is not the whole story. Not even close. See, to place this trade on Robinhood, you need to put up some collateral. It's like a security deposit. In this case, they'll lock up $250 of your buying power to cover the trade's maximum potential loss. But now, check this out. For the identical trade on Tastytrade, their risk algorithm is way more sophisticated. It crunches the numbers and figures it only needs to hold $165 of your cash. Because it has a better handle on the actual probabilities, the collateral it asks for is way more precise, and in this case, a lot less. Let that sink in. That's an $85 difference. For the exact same trade, Robinhood is tying up an extra $85 of your money. If you're an active trader, that is a huge deal. This is what people mean when they talk about capital efficiency, making every single dollar in your account work as hard as possible. That extra $85, on Tastytrade, you could use that to put on a whole other trade. Okay, so what's the takeaway here for you personally? Let's just break it down into a simple framework so you can figure out where you fit in. All right, first up, let's say you're a new investor. You're mainly just looking to buy and hold some stocks, maybe a few ETFs. For that, Robinhood's simple, clean interface and zero commissions make it a really great place to start. But what if you're an active options trader? Someone who's constantly working with spreads and more complex strategies. Then it's not even a contest. Tastytrade is the clear winner. The better tools, the deep analytics, and most importantly, that capital efficiency we just talked about. It's all built specifically for you. But wait, there's a third type of person to consider. Let's call them the disciplined long-term investor. For this person, Robinhood's 3% IRA match could be a massive draw. But, and this is a big one, it only works if you have the self-control to just set it and forget it. You have to ignore all the shiny distractions and be ready to commit to their 5-year holding period. So at the end of the day, it's not about which platform is the best. That's the wrong question. They're just different tools for completely different jobs. You wouldn't say a hammer is better than a screwdriver, right? It all depends on what you're trying to build. Picking your platform, that's often the very first decision that starts to define what kind of investor you are. So now that you know the tools a little better, the real question isn't just about the platform, it's about what kind of investor you're going to be. Thanks for tuning in.